Is cryptocurrency really the future of finance or the worst investment you can make? In the recent past, we've witnessed an unprecedented rise in the popularity of cryptocurrencies. From Bitcoin, the first and most well-known, to thousands of other digital coins like Ethereum, Ripple, and Litecoin, we are in the midst of a cryptocurrency revolution. The world's fascination with these digital assets is palpable, but what is driving this global interest? Cryptocurrencies promise a future of decentralization and financial freedom. They offer a new way of handling money, separate from traditional banking systems. Imagine a world where you have complete control over your finances, free from government oversight and banking fees. It's a world where financial transactions are peer-to-peer, directly from one person to another, without any middlemen. This is the world that cryptocurrencies promise. Another appealing aspect of cryptocurrencies is the concept of decentralization. Unlike traditional currencies, which are controlled by central banks, cryptocurrencies are decentralized. They are not tied to a specific country or government, giving them a global appeal. Moreover, cryptocurrencies offer a level of privacy not available with traditional banking. Transactions are recorded on a public ledger known as the blockchain, but the identities of the parties involved are kept private. This privacy feature has attracted many to the world of cryptocurrencies. However, despite the allure, cryptocurrencies are complex. They operate on a technology called blockchain, which is a type of distributed ledger. Understanding how this technology works can be daunting for many, and this complexity has led to misinterpretations and misconceptions about cryptocurrencies. As we stand at the cusp of a potential financial revolution, it's essential to question and understand what we're getting into. Cryptocurrencies are not just digital coins. They represent a shift in how we perceive and handle money. They promise a future of decentralization, peer-to-peer transactions, and financial freedom. But is it all glitter and gold in the world of cryptocurrency? Let's delve deeper. When we talk about investments, we typically think of stocks, bonds, real estate, and mutual funds. But how does cryptocurrency stack up against these tried and tested methods? Diving into the world of financial investments, we find ourselves amidst a vast ocean of opportunities. Traditional investments like stocks, bonds, real estate, and mutual funds have long been the pillars of wealth creation. These avenues have an extensive history that showcases their resilience, stability, and steady returns. But then, here comes the new kid on the block, cryptocurrency, promising high returns and a revolution in financial systems. But how does it really compare? Let's take a look at stability. Traditional investments are backed by tangible assets or government guarantees. Stocks represent ownership in a company, bonds are loans to governments or corporations, and real estate is, well, real. Cryptocurrency, on the other hand, is predominantly backed by nothing more than the belief that someone else will pay more for it in the future. This lack of intrinsic value contributes to its extreme volatility. Historical performance, too, favors traditional investments. Over the past century, the stock market has on average returned about 7 to 10% per year. Real estate and bonds have also shown steady, albeit slower, growth. Cryptocurrencies, with their decade-long history, have shown meteoric rises and spectacular crashes. Remember, past performance, while not a guaranteed predictor of future results, can give us some indication of what to expect. Lastly, there's the aspect of regulatory oversight. Stocks, bonds, and mutual funds operate within established legal frameworks, providing investors with certain protections. Cryptocurrencies, however, operate in a largely unregulated environment. This means that cryptocurrency investors are more exposed to fraud and manipulation. While the potential for high returns may be tempting, the risks associated with cryptocurrency might make you think twice. One of the biggest concerns with cryptocurrency is its extreme volatility. This volatility is the rapid and significant price changes that can happen in very short time spans. It's like a roller coaster ride, only that this ride doesn't just churn your stomach, it can also significantly affect your financial well-being. Let's take a trip down memory lane. In December of 2017, Bitcoin reached an all-time high of nearly $20,000, only to plummet to around $3,000 a year later. That's an 85% drop. Imagine, if you will, having $100,000 one day, and then waking up a year later to find you're left with just $15,000. This isn't a one-time event. It's a recurring theme in the world of cryptocurrency. Ethereum, another popular cryptocurrency, also experienced a major crash. It reached a peak of around $1,400 in January of 2018, and by December of the same year, it was worth just $87. That's a drop of over 90% in less than a year. But it's not just about the crashes. Cryptocurrency prices can also skyrocket in a blink. Take Dogecoin, for instance, which started as a joke, surged more than 12,000% in the first 4 months of 2021. This rapid rise might seem like a dream come true, but remember, what goes up must come down, and the fall can be just as quick and brutal. What's driving this volatility? A myriad of factors. Market speculation, regulatory news, technological advancements, macroeconomic trends, and more. The lack of liquidity in the market further exacerbates the volatility, leading to even more drastic price swings. The bottom line is, while this volatility might be a trader's dream, offering opportunities to make quick profits, for the average investor, it's a nightmare. It's like trying to build a house on quicksand. You never know when the ground beneath you will shift, swallowing up your hard-earned money. While volatility might be a trader's dream, for the average investor, it's a nightmare. Cryptocurrency operates in a largely unregulated market, akin to the Wild West. When we talk about the Wild West, we think of lawlessness, risk, and uncharted territories. It's an apt metaphor for the cryptocurrency market, where regulation is still a work in progress. In this vast digital frontier, there are no sheriffs to enforce the law, and no courts to settle disputes. This lack of oversight poses a significant risk to investors. Imagine a world where the rules of the game are constantly changing, or worse, there are no rules at all. That's the world of cryptocurrency. In a traditional market, there are regulatory bodies that ensure transparency, protect consumers, and maintain fair and orderly operations. But in the crypto realm, these safeguards are largely absent. Without these checks and balances, the potential for fraud, scams, and market manipulation increases. Initial coin offerings, or ICOs, have been particularly notorious. With flashy websites and grand promises, many ICOs have lured investors into parting with their hard-earned money, only to disappear without a trace. Pump and dump schemes, where prices are artificially inflated to attract investors before the fraudsters sell off their holdings, are also common. The lack of regulation also means that the value of cryptocurrencies is highly susceptible to market sentiment and speculation. This makes the market extremely volatile, with prices swinging wildly within a matter of hours. Investing in cryptocurrency is not like investing in stocks, bonds, or real estate. It's more akin to speculating, betting on the rise and fall of prices. It's important to remember that the value of a cryptocurrency is not based on tangible assets or cash flows, but is purely speculative. This lawless, unpredictable nature of the crypto market, combined with its potential for fraud and manipulation, makes investing in cryptocurrency a high-risk venture. It's not for the faint-hearted, and certainly not for those who can't afford to lose their investment. Without oversight, investing in cryptocurrency is akin to gambling, not investing. In the world of finance, history often serves as our best guide. But with cryptocurrency, there's not much history to go on. Picture, if you will, a financial landscape where the oldest player is just about a decade and a half old. That's cryptocurrency for you, the new kid on the financial block. Bitcoin, the first cryptocurrency, came into existence in 2009. That's less than 15 years of history compared to centuries of data we have for traditional investments like stocks or real estate. This limited history creates an environment of uncertainty. With traditional investments, we can analyze trends, identify patterns, and make predictions based on historical data. But in the case of cryptocurrency, we are essentially walking in the dark. There's no established roadmap, no historical patterns to rely on, and no way to predict what might happen next. Adding to this uncertainty is the fact that the cryptocurrency market has been marked by dramatic fluctuations. From the meteoric rise of Bitcoin to the sudden crash of various altcoins, the history of cryptocurrency is a rollercoaster ride of highs and lows. This volatility, coupled with the limited history, makes it extremely challenging to make informed investment decisions. Furthermore, the future of cryptocurrency is shrouded in mystery, with regulatory bodies worldwide still trying to figure out how to deal with this digital currency. There's a lot of ambiguity about what the future holds. Will governments embrace it or ban it? Will it become a mainstream form of payment or remain a niche investment? These unanswered questions add another layer of risk to investing in cryptocurrency. So, is cryptocurrency the worst investment you can make? That's a decision only you can make. But remember, high risk doesn't always mean high reward.